Let's bring in University of Michigan economics professor Justin Wolfers. Good to see you as always. What do you make of the Fed decision to keep interest rates steady?
Well, it's pretty much what everyone expected. The Fed was very careful in what it said, and I think the real news actually was in the press conference. Jay Powell sounded what you would call hawkish. Hawkish means particularly worried about inflation and the likelihood of further rate cuts. It became a little bit less likely that we'll see too many rate cuts anytime soon. The Fed seems very worried about inflation. I personally am a little bit more worried about unemployment rising. And the problem with the current moment, the problem with tariffs and the problem with war is these are both what economists call supply shocks. Supply shocks create two bad things at the same time: higher inflation, higher unemployment, and that's why things feel a little bit more grim this morning.
Just sticking with the rates, analysts are saying at most one cut this year from the Fed. Any idea? What are you seeing?
Yeah, so in fact, Powell pointed to this directly yesterday in the press conference. If you look at the precise median, the middle person on the Fed, they're currently at two cuts, but a sizable number of people moved across to one cut. It's actually very hard to talk about the future right now. It's always true, but it's doubly true right now, which is no one knows how long Iran is going to go on for. And the longer it goes on for, the more disruption it causes, the more that turns from purely a national defense story or a foreign relations story to an economic story. And it could very easily become the overwhelming economic story of the next few months. And if that's the case, everything's up for grabs.
You touched on the inflation problem, wholesale inflation coming in hotter than expected for the month of February, rising the most in a year. What does this tell you, and where will Americans, do you think, feel it the most?
Yeah, so look, the president promised us that he'd get prices down on day one, and he hasn't done that. There was obviously a first set of tariffs, and part of what's going on right now is those tariffs still working their way through the system. Remember, we spent so much of last year, the tariffs are on, the tariffs are off, the tariffs are on, the tariffs are off. Right now they're on, and they're continuing to be felt. But what people are really going to notice is gas prices. There's a very, very quick feed through from when oil prices rise, and they're rising literally minute by minute, to changing prices at the pump. And you're already seeing that. Gas prices are up about 30%, but oil prices are up even more, suggesting that you might see a little bit more pain at the pump.
Yeah, in fact, just today, gas prices are up 90 cents a gallon since this war began, which is less than 3 weeks ago. Oil prices hit nearly $115 a barrel this morning after the overnight strikes on energy infrastructure in Qatar. I'm just wondering, why didn't tapping into those emergency reserves seem to have much of an effect?
Because what's in those reserves, it feels very impressive. It's millions and billions of barrels, and that feels like a lot. But what is stuck in the Middle East right now, stuck because you can't get any oil through the Strait of Hormuz, is much, much larger. Look, the problem is that 20% of the world's oil comes through there. There are some workarounds, but they're very imperfect. The reason prices rise so much is if we have a bunch less oil, we got to figure out a way to get people to use a bunch less oil. And what markets do is they jump up the price until your family stops driving for vacations, that people cut back in a variety of ways. And that's the only allocation mechanism that we have. And so those high prices are reflecting the fact, one, oil is in short supply, and two, it's pretty much an essential.
Here's what the vice president is saying about the rising gas prices. Listen.
Look, gas prices are up, and we know they're up, and we know that people are hurting because of it, and we're doing everything that we can to ensure that they stay lower. I will say, the president said this, and I certainly agree with it. This is a temporary blip, okay?
Justin, a temporary blip, or are people going to be paying more for a while?
The vice president's lying, and the vice president knows it. He knows it partly because he knows that there's ongoing disruption and it's going to be around for a while. The longer this goes on, actually, some of the oil wells get shut down. It becomes very difficult to open them back up. And let me tell you how we all know the vice president's lying. There are very big markets in what are called oil futures. Basically, you're buying oil for next year or the year after. And we can see already what those prices are doing. And so what has gotten all the headlines is that the price of oil today has gone up very, very sharply over the past few months. But the price of oil for 2027, 2028, even 2029 are much higher than previously was. This is not just a short blip. This is going to be with us for a while. Maybe not as sharply as it is right now, although things could always get worse. But I think people should be making plans that oil is going to be a bit more expensive for quite a while.
Justin Wolfers, thanks for that reality check. It's good to have you here.